Okay, now whenever I calculate my ratio, there is a numerator, there's a denominator in most of the ratio, which will have into 100 if you want to express in percentage. If you want to express in days and all, it will be 365 divided or into 360, something around that you will do. Now, certain ratios take two items from balance sheet. Example, current ratio. Current ratio is current asset by current liability. Both the items are coming from where? From the balance sheet. Certain ratios will take both from P and L. Net profit ratio, net profit divided by sales. There are some ratio where one item comes from P and L, one item comes from balance sheet. Example, debtors turnover ratio. Debtors turnover ratio is sales divided by debtor. Sales comes from your P and L, debtors come from your balance sheet. Now there's a general rule, which is a very important rule you should remember. Any ratio which has one item from P and L and one item from balance sheet. This is a general rule which you need to remember. I may not follow in all the question because of lack of information. Which takes one item from P and L, one item from balance sheet. You should take the average of the balance sheet item. You should take the average of the balance sheet item. You could have learnt many ratios where they'll say in the denominator average and all, but this is the real concept. Concept is if you take one item from P and L, one item from balance sheet. Example, debtors turnover ratio. Formula is sales divided by average debtor. It's not debtor. Sales divided by average debtor. Net profit margin. Net profit margin, net profit by sales. No concept of average net profit, no concept of average sales. Current ratio. Current asset, current liability. No average current asset, no average current liability. Now, why do I do this? Let's understand. P and L is for the year. P and L is for the year. My sales is done from April 1 till March 31. At the end of the year, some rare event happened like COVID, because of which money did not come from my customer. Money has not come from my customer. When money did not come from my customer, debtors went up. Debtors went up. But sales was not impacted fully. Sales got impacted only 1 month. So my numerator is an item which is not impacted. Balance sheet is an item which got impacted at the end of the year. To reduce this impact little bit, we take average. We take average. If unfortunately even in the last year, this year, both year you got impacted on the balance sheet, can't help it. But to reduce the impact little bit, we say we will take the average of the balance sheet item. Now why I don't do it for two balance sheet item? Because both balance sheet item would have got impacted. Current ratio means current asset would have also got impacted because of COVID, and current liability also would have got impacted because of COVID. If both got impacted, I have no problem. But only problem is my numerator or denominator, that is the P and L item, is not impacted by COVID in that year. It will get impacted when next year. But balance sheet item got impacted. Balance sheet item got impacted. So concept is very simple. If you are taking one item from P and L, one item from balance sheet, we done ROE, return on equity. We used to use a formula called EAT divided by amount of equity. Wrong. EAT divided by average amount of equity. You should take average amount of equity. We used to do cost of capital as EBIT divided by debt plus equity. No, average debit, average debt plus average equity. What is average? Opening plus closing. Opening plus closing you will have to do. Why all these averages are needed? To ensure that you are not impacted by an as on date figure. By as on date figure. I can even go to the extreme saying that I want to take average of every month. If I have data, go ahead and take average of April, May, June, July, August, September. That's in fact far better. But obviously whenever we do questions or even in practical world, when you want to analyze income statement and balance sheet, you will not get monthly averages. But what you will get? Opening balance sheet, closing balance sheet, or last year balance sheet, this year balance sheet. You know how to take average and then you can go ahead. Now write a ratio. A ratio can link two items in this manner. Both items from P&L. Example, net profit margin. One example I'm giving. Both items from P&L, net profit margin. Both items from balance sheet, current ratio. Both items from balance sheet, current ratio. One item from P&L and one from balance sheet. One item from P&L and one from balance sheet. An example for this is your return on equity or debtors turnover ratio, whatever way you call. Now this is not the only item. I may have a rare question where I may go beyond this. What is beyond this? One item from financial statement, one item from non-financial statement. Total revenues divided by number of employee, divided by number of employee. Are two items which are not there in balance sheet or P&L. Example, student teacher ratio. Student teacher ratio. Number of students, Bharadwaj Institute does not write in their balance sheet. Number of teachers also not written in the balance sheet outside the income statement. So I can have any item like this. I'm just focusing on these as of now. Very rarely you may find a ratio beyond this. Now just write in category 3 in bracket one item from P&L and one from balance sheet. We should take average of balance sheet item available. Average of balance sheet item. 90% of our question we will not have the data. Will not have the data to take average. That is, they'll not give the opening balance sheet. But wherever available, please go ahead and take average.